Hello, I'm Troy Harmon, Chief Investment Officer for Henssler Financial, and this is your market update for July 2018. Guys, S&P 500 is finally back above zero, right? We're about 3.5% on the year. Technology still leading the pack.
No surprise there.
Consumer staples still in the basement.
Yeah, but if you take a look at what's kind of
surprise.
happened over the past week, really towards the end of the month, you've seen somewhat of a rotation out of the cyclicals, moving into more of the defensive names, utilities, staples, things of that nature.
Right, yeah, one of the biggest economic points that we've got recently is employment situation, and it was a surprise to the positive, right?
Yeah, that's right. 213,000 jobs were added to the economy in June. That's better than the 195,000 that was expected. Now, we did see a tick up in the unemployment rate to 4% from 3.8, which was kind of a surprise to us. But at the same time, the reason for this is that you saw the labor participation rate jump up to 62.9 from a previous 62.7. So more people, not a huge move, but more people entering the job search, the job hunt. So
then we've got the Fed. We got an interest rate increase in June. Got another one expected in September, right?
Right.
And then a fourth in December. The market is now indicating that we'll see four interest rate increases in 2018.
Right, and it was a 0.25% hike, 1.75% to 2% is the new range. And I would say kind of the details of the minutes were a bit more hawkish than expected. The Fed seems optimistic of the domestic economy, at the same time acknowledging that there are some risks abroad.
Yeah, what's not to be optimistic about? The government, at least, is telling us probably almost 4% GDP in the second quarter, 25% earnings growth among the S&P 500 companies in the second quarter. That's pretty good stuff.
Keeping at the same steady pace with the QT as well. I think we got up to 30 billion.
Yeah, this is the first time,
With the roll-off. I think by October will be to 50 billion.
And that's just the Fed unwinding of the balance sheet.
The real number that I see, I looked up the data from even last week, and it's showing about $100 billion having rolled off the balance sheet since October of 2017. So we are going in the right direction there, trying to reload a little bit, but it's going slow.
The one thing that I'm watching right now is the yield curve, though, because we see, if we look at the 10-2, we're seeing that at 27 basis points now. Typically, in a late cycle environment, as the economy starts to slow down, that's when you see the yield curve invert.
Right, historical low since the last recession, and hopefully we don't see that yield curve invert.
There's been periods before where we saw the yield curve invert, and we still had economic growth for another year or two.
As of Friday, the tariffs took effect. I think $34 billion in tariffs the U.S. Imposed on China. China did the same on the U.S., focused mostly on agricultural goods and automobiles. So how does that play out? We don't know. Is it a negotiation tactic?
Yeah, I think that's really what we've been, what I expect at least, is that somebody at some point will blink. If you look at returns, we just talked about the S&P 500 is up on the year 3.6%, something right in there. You look at the Hang Seng, it's down almost 6%. You look at the Shanghai Composite, it's down almost 13%. Who's winning this battle? If you just look at those three indices, U.S. I think all things considered, we are the world's consumer. Nobody really wins in a trade battle, but the reality is we're faring better than China.
And I think you can see that in the PMIs too. If you look at U.S. PMIs versus global PMIs, look at Eurozone, look at China, U.S. is still holding up towards cycle highs where we've seen that rollover in Germany, China, etc.
Right, yeah. So in a forward-looking sense, we're going to continue looking at those tariff situations, in the month ahead. It really is important. If we don't see somebody blink, you could see some true economic damage here.
Sure, and it's tough. It's really tough to play that situation because it really is a wild card. We have no way of knowing
it's human
what's
action
going to happen.
and the reaction to those actions. So that it really is hard to model, hard to forecast. The other piece is economic indicators. We all believe, the three of us believe that we're late in the business cycle domestically. You know, it's been since 2009 that we had a recession, or the end of the last recession. So we know that business cycle has not been changed. It's still alive and well. We will see some sort of a contraction at some point, and we're watching closely for that. One of the things that we look at is earnings yield, real earnings yield.
It's kind of the way we root ourselves in evaluation. So we look at the inverse of the PE, which basically tells you how much you're getting paid in earnings for what you own,
right,
and we subtract inflation from that. So now that we've seen CPI move up to 2.8%,
yeah,
we feel like valuations might be a little stretched here. We're getting up close against that like 2% earnings yield.
Right, yeah. We're still, I mean, we use a longer term approach so that we can look and make sure that we're not getting noise in the signal.
Right.
And that longer term piece is still not giving us any reason to have an issue. So,
but it's something to watch.
Absolutely, yeah, and that's what we'll be doing going forward. We believe the economic situation at the moment is pretty solid, but you know, tariffs can change lots of things.
The employment picture continues to look solid. Continuing claims, I think, are at a 30-year low, almost 40-year low. Yeah. So the employment picture still looks bright as well, which is another indicator that we watch.
Right, no doubt. That's been your market update from Henssler Financial for July 2018. Thank you for watching.